Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I will interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me, it's at @fingerscorefinance. If you want to join our community, finding-value.com. We do have a special going on. Special is the coupon code. You can save 50% off the first month, or you can save a larger discount on the yearly membership, either directly signing up to the yearly membership or switching from the monthly to the yearly. Going into Josh Young, he says the majority of investing mistakes come from trying to cram long-term returns into shorter periods of time. Just be more patient. It's not more complicated than that, says Morgan Housel. So what happens? How do people blow up? They take leverage, they borrow money, they do options, they do things where they are trying to cram greater returns in shorter periods of time. And that's where major problems generally exist. Another thing that a lot of people do is they try to make more money. So what they do is they go after short-term returns, which is trading, and then they also go after the things that are going up the most. A lot of the times those can have big reversals, and sometimes they're uh, way overvalued. So that's where the combination can really get you is you're chasing price performance using overvalued assets, using leveraged products in things like options. And then you add it all together, and that's where you blow up. Here's Tavi. It says emerging markets have a deep and often underestimated connection to the metal in my view. And he's right. And I can tell you what that connection is, in my opinion. Says historically prolonged bull markets in gold have contributed to broader increases in natural resource prices, strengthening economies with substantial exposure to commodity markets. Emerging markets, particularly resource rich South American nations, category. Additionally, the structural constraints on further US dollar appreciation, which I firmly believe to be the case, create a highly favorable macro environment for emerging market economies to benefit. So gold's already taken off. That's our leader for the commodity bull market. We've got emerging markets here, which is lagging behind. And I do think that emerging markets are going to go up. Why? Why is that the case? Well, let's go look at how this is priced. This is gold prices in dollars per ounce. So the ounce is the same no matter what. This is a decline, dollar decline. And then what happens when the dollar declines? The currencies of emerging markets go up. And sometimes, depending on the currency that you're looking at, they go up substantially. So money goes where it gets returns. And money will flow out of the dollar if the dollar is substantially underperforming, we'll call it emerging market currencies. So really, emerging markets, more or less, is one gigantic play on currency differentials. And let's look at this. We've got higher lows coming up. We've got a resistance trend line, a resistance line right on top here. It's a horizontal resistance line. This goes back all the way to 2008. We break this, we are going to be breaking a major consolidation. And the consolidation in gold happened in 2011 onward. We broke that consolidation. It's running. I think emerging markets are going to rip. And there, on the website, we talk about some of these ways to play the emerging markets in specific companies. And I've got a few companies that they borrow in dollars but earn in the local currencies, emerging markets. And what that does is it's just one gigantic leveraged play to the currency appreciating, the emerging market currency appreciating against the dollar. And not only will they increase their production and sales, of whatever they do in a commodity bull market, they also get the currency differential that benefits them because they have debt denominated in dollars. Conversely, though, you get absolutely destroyed as a company if the dollar goes up in value against the currency that you collect in. So it's one gigantic leveraged play where if you can time, it's not about perfectly timing it, but if you can generally time this rotation of capital, and you've got companies that are like that, you can get really big returns because the downside is so overblown from currency exchange rates and the commodities pulling back. And then on the opposite end, it goes all the way up because of currency exchange rates and the commodity appreciating. So last bull market, some of these went up 100 times in value in a 10-year period, 8 to 10 year period. Well, 7 year period, I guess, because it was about '01 where it bottomed and started going higher all the way into 2008. Coming back. While gold prices have reached new record highs, gold producer stocks are still far from their 2011 peak. We see this gigantic gap between what I would call the ratio of gold and silver mining companies in relationship to the gold price itself. It says when gold prices have reached new record highs in 2024, gold producer stocks are still far from their 2011 peaks. A lot of people say, well, why? Why are we hitting new highs in gold and how come these aren't moving? My opinion is that we still have a bull market over in NASDAQ and S&P 500. And money hasn't rotated into these sectors very forcefully yet. Nothing is forcing those other investments out of their investments. So what is needed for most of these bull markets is it needs an underperformance of the S&P 500 and NASDAQ in relationship to gold and gold silver mining companies and stuff. And then the second portion is actual pain is inflicted in those portfolios where they go down. That occurred in 2000, 2001, and we saw money rotate into this stuff during that time frame. The pain was inflicted in 2000, 2001, and then you can see it take off. I do think that's coming. We're very close, and we just have to be patient for it. Gold's our leader, and it has taken off. I have in here, are you not entertained from the movie? What movie is that from, guys? Put it in the comments section. Here's iShares China, which is FXI. We've got the 3-hump consolidation, and then we've got the breakout lower. I think this is a false breakdown, a double bottom, and then I think we're going to move on up. That's what I think is going to happen there. We've got EWZ, which is the 3-hump consolidation, and then the move lower, which this is a false breakdown, and I think currencies are going to be driving these higher. And this is S&P TSX Venture going all the way up. And if you flip it, obviously this is going to reverse lower, I think, for the TSX to outperform based off currency differentials. So it says, you do realize everything I'm posting is interconnected, right? Here's the currencies. So last bull market for commodities was a currency exchange differential going up for Canadian dollar outperforming US dollar. We came off of the falling wedge upward. We've got a falling wedge, the 3-hump consolidation, and then this little spot in the end here is the little spot on the end here. One thing I will say is the size of this falling wedge, this new one, is bigger than the previous one. If you look at Fibonacci and a lot of these extensions and whatnot, I do think that this will be a bigger bull market that comes because of the size of the fractals. And then this is BRL USD coming all the way down. We've got that double bottom going on with a slight pull down below, which could be a slingshot. Maybe, we'll see. We got Australian dollar versus the United States dollar, big downtrend from 1971, big downtrend all the way where it bottomed 2000, 2001, and we came on up, and that was your bull market in commodities here. We had another consolidation. We are in the corner of this where we could potentially break higher for the Australian dollar breaking out against the United States dollar. It hasn't broken out yet, but we'll see if we can get one here soon. And then this is the South African rand versus the dollar. We have a falling wedge. We've got the 1 hump, 2 hump, and 3 hump consolidation, and it's also in the corner. This has been declining ever since 2006. So it's a very similar situation to Australian dollar, Canadian dollar, and Brazil. They're all commodity currencies for the most part. We'll see if we can break out. And these currency differentials, as they break out to the upside of all these, money will rotate into those currencies and investments denominated in those currencies. We've got, they say gold is the leader for commodities bull markets. Well, then here we are ripping to the upside, and gold is leading. So I would expect commodities and these currencies and everything that I'm going over to eventually turn and break out here as gold is the leader priced in dollars. So it's the dollar falling. Here is gold divided by the S&P 500. We can see a downtrend line break and a potential big double bottom. So that looks good. We've got crude oil against the S&P 500. We're still scribing out the double bottom here, I think. Last commodity bull market was from 1999 up to 2008, which was the peak, and we fell down off of that. So I think this is the big bottom here that will eventually break to the upside. We're still very, very early. And this is the double bottom that I'm talking about. This is in Stan Weinstein's book. Here's the double bottom, the breakout. A is the breakout, B is the backtest. And that's where they say is the ideal entry point. But I like buying down here in these corners because you have the ultimate appreciation for the entire move. Commodity bull market and capital rotation coming. Why? Because gold is the leader and it's broken out and it's beating all of these other metrics. So these will eventually follow. We're at a very low point for commodity to Dow Jones Industrial Average ratio. Notice these numbers, 1931, 1969, and 2022 is 1931, 1969, and 2022, U.S. stock and versus bond returns. Why are these circled here? What this is that you've got the bond return and the U.S. stock return quite negative. So they're both negative in these particular years. They were both negative in these particular years that coincided with a cheap 1931, 1969, and 2022, which is right over here. So this is the commodity to stock ratio. And when this is cheap, it means that we've got limited downside and a whole bunch of upside potential. It also means that stocks are expensive. So this is the everything bubble except for commodities. And that's what this is indicating. So this is the last dot-com bubble there, and we are in another bubble here. Now, does that mean that this can't stay down for a while? It can stay down for a while. It can take time, and that's where patience is required. This is the TR Jeffries CRB Commodity Index. What I did, this blue line is the last bull market. I took this bull market here where the ratio bottomed in 1999 and peaked in 2008. That's 2008 peak, 1999 bottom. So I took this ratio, projected it on here where these circles are, and I copied that fractal, overlaid it on the new fractal, and this is what it's going to look like over time, where the index, at least where it is from today, is going to triple. We also just recently broke out to the upside of this to start this third leg. This is the first leg, second wave, third, fourth, and then the fifth. The fifth wave on these commodity bull markets are pretty big. The third's generally the biggest, but the fifth can be a very big wave too. So that's what it looks like, and this is what I think is coming in commodities. Now, some people will say commodities haven't gone anywhere since 2021. That is a correct statement, but we are in the super cycle and people don't even know it. they don't understand markets. Your consolidation period is this falling wedge. It's a 1, 2, 3 hump consolidation, a breakout. So as this is broken out, the big move that I think is coming is going to be driven by a weakening dollar. That's why these currency plays are so valuable and why they're all in falling wedges ready to break out. And this is going to be the extra juice on top of the hidden secret, is what I'll call it. This is the hidden secret of currencies, um, and money flow and rotations. Here's commodity bull market and capital rotation incoming. This is the commodity bull markets. Remember 1931? Well, that's happened in the beginning of this consolidation. 1969 was the beginning of this consolidation. And 2022 could be the beginning of a consolidation. Now, it doesn't mean that that will be the peak. We could go a little bit higher and then pull back. It did it here a few times, but I think we're going to eventually trade sideways. So each of these commodity bull markets, we saw the S&P 500 here trade sideways, and I think we're going to see that again. This is the three inflationary waves. The COVID supply shock is first wave. The second wave, which is going to start in 2025, according to the beta drought decade here of Meta C. Services, energy, and food are going to be the big one that run. And we on the website, we are positioned for these particular outcomes. And then the last one here is shelter, is what they've got for the last big move. So we're at the beginning of the three waves. Some people say that we're here. I don't think so. I think we're at the beginning and 2020 is the bottom. Well, why do I say that? Well, it deals with where we're at in the ratio. We're too cheap. Also, what drives this and potentially up here is household growth formation. The reason it does this is based off of the demographics coming into home buying years, the peak spending years of this demographic, which is the millennials, and them creating credit from the monetary banking system. So it's a combination of all those things. Here is yields, and yields are also agreeing with my opinion. Yields have broken the 40-year downtrend. This is the 10-year yield. Last time it did that in the 40s. And then we ran all the way up to the peak of 1970s, 80s. We just recently broke out of this in 2021, and we are starting that. Why is this such a big deal? Well, if you look at bond yields and equities, they tend to be positively correlated where bonds and yields go up together up to a certain point. That certain point is 5%. So when the US 10-year bond yield goes above 5%, they become negatively correlated, where bond yields go up and the stock market goes down. That's going to force capital rotation, in my opinion. So what I think Trump and the Federal Reserve are going to try to do is they're going to try to hold yields underneath 5%. They want to have lower yields. But if inflation keeps coming, it's going to be a pressure to push yields higher as people don't want to buy bonds. And this will eventually weigh on the stock market. And this will cause capital rotation. So that is kind of how this all is interconnected. This will start going sideways when interest rates get high enough. Or when they become, there could be a weakness too, where things start to topple over and we get a recession. That happened in 2000, 2001. That also happened late 60s, early 70s, where it started it. 29, that was bad. So we could have a potential pullback at some point that starts this big commodity bull market and a capital rotation event, so to speak, is what some of the guys call it. This is Bitcoin 6 months closing price. What do you think? I have a rising wedge here, and I just threw that up. I just threw it up. I didn't say it was going to go lower. I didn't say it was going to go higher. I just said Bitcoin 6 month closing price. What do you think? Rising wedges generally break downward. I like how they said downtrend, uptrend, uptrend, downtrend. So we'll see. We'll see what happens. And one thing that I will say is if this trades like the NASDAQ, well, that's going to be subjected to all the same forces, market forces that is up here. So when we start to get above 5%, I think that this is going to it could roll over. And this could also be an indication of where we're at, where if this does break lower, it's an indication that things are rolling over and that interest rates are having an impact on the markets. Silver 6-month closing prices, it looks clean. What do you think? And I've got the cleanest cup and handle pattern I think I've ever seen. We're right there trying to break out of it. The projected price move of the cup, projected upward, is $350 an ounce. So when you look at this, it says in-depth cup and handle, the previous uptrend. There's your cup and handle, the entry, and then the measured target. That's what we've got going on there. The market sniper, he says the future for US government jobs is bleak. The overdraft for overspending has been pulled. It's a debt-based collapse. So right here, this is the unemployment filings hit a 3 times 2024 average for this is Washington, D.C. And this is Doge laying off a bunch of government workers. Could this potentially cause a recession? Yeah, I know we were doing a ton of fiscal spending, pump, 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 pump with fiscal spending. And this could cause a potential recession if we are laying off a lot of government workers. So savings in government spending could induce a recession with all the unemployment. And Patrick Karam had the same thought that I did. He says, do we have an estimate on how many jobs Doge will eliminate per month? My thinking is, how will this impact unemployment figures? Is it enough to trigger a market reaction, hint recession? And I have the same thing. When I was looking at it, I was like, well, crap, if they cut big enough, how big of an impact is this? JC says the worst investors let their politics influence their investing decisions. You can see it on this platform every day. The latest one is deciding not to profit from Chinese stocks ripping because you don't like communism. Laugh out loud. Casper says, show me the most explosive setup if you like back 4 years. So a 2, 3, even 4-year fractal setup. Go. I can be anything. I start platinum. A big platinum bull from Casper. I am too. And I'm not sitting here, I don't care if it breaks out, this month or next month or 6 months from now. I'm in it to win it. Let's let this thing rip. I'll let it, I'm just going to let it ride. Here's a copper fractal or chart pattern, I should say, similar to silver versus M2 money supply. Copper appears to be forming a 10-year inverted head and shoulders pattern relative to the M2 money supply. A break of the inverted shoulder head shoulder would result in a lot more inflation. Shoulder head shoulder, and this is ready to potentially break at some point above that neckline. Looks really good. Eric Ewan says, my pin post will play out exactly as it was written in 2022 during the depths of the gold and silver ultra slams. So it says gold price revaluation will screw over most people in the world except for a few physical gold owners because it is an act by central banks and sovereigns to capture productivity from common folks to write off their debts and finance government. 4. Most small investor peeps are invested in miners, which are physical gold proxies. When physical gold becomes difficult to get or unavailable, and GLD gets exposed as bullcrap, miners will fly because they are the only gateway for the mass public to be exposed to physical metal. There it is. I agree. Here's Warren Buffett. He says, you'd be better off if you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You would think long time. You would think a long time before every investment decision. You would make good ones, and you'd make big ones, says Warren Buffett. And I brought this up on the website, kind of answering what my top picks would be for the commodity bull market. This is where it came from. It came from this 20 punches on it. And if I were to only have 20 punches, how would I approach the market? I will say this. I wouldn't be in a single junior company if all I had were 20 punches. I wouldn't be in any company that doesn't make any money. They'd have to have infrastructure. They'd have to have cash flow, and they would have to be undervalued with a great chart pattern and all these other requirements for me to enter the particular investment. So what it does is it weeds out all the crap. It weeds out all the crap. JC Parrott says, what does the bond market know? And we've got a rising interest rate while crude oil is still delayed behind it. Interest rates generally move with inflation, and this is inflation protected treasuries versus nominal yielding treasuries. And I think he means that's the ratio. So inflation, the ratio of the protected treasuries versus nominal yielding is going up, and it's generally a strong correlation between tip IEF and crude oil. I think crude oil is going to rip. I think it's going to rip, rip, rip. These are generally correlated, and the bond market is usually where the smart guys are at. So crude oil is just lagging behind. It's also at a 40-to-1 ratio to gold. So gold's our leader. Gold generally runs first. You've got tips and IEFs running first. You've got gold running. And then almost always, I don't think I've ever seen a time where you've got yields going up and gold going up, where oil's like made some huge move lower. I don't think that's existed in history. Usually they move together, where oil and tips go down, but there's a disconnect here. Gold supply projections coming in hot. So this was from last time. I'm going to end it there. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got that special coupon code, which is special, is the coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.